take me for rides when he was home. But I guess that's all over now since my daddy's gone. Not one breaker came back on that old CB as a little cripple boy talked with me. I tried hard to swallow a lump that just wouldn't stay down as I thought about my boy back in Greenville town. Dad was going to take Mom.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week, each and every month, year, however long it is that we've been on the air since, I don't know, about 10 years ago. What we've been trying to do lately is to try to figure out what the market is doing. And what I mean by that is the rates keep rising. Yes, that's a very steady and focused way by which you can look at things. But the economy itself, we've been predicting recession, we've been predicting downturn, and everybody wants a downturn in the mortgage industry. Why? Because usually when that happens, we see rates fall. And there isn't a buyer out there in the world right now who has bought a home recently who would have loved to have a recession, obviously keep their job, because the rates would have fallen. If they fall a point, point and a half, 2 points, that's a boom for the mortgage industry. But as it is right now, that isn't happening. A couple of things going on in the economy. It's actually doing really well. And one of the things that surprises me all the time is that anytime you predict something in the mortgage industry, it does not happen. For a year and a half, 2 years, I was predicting this recession. I've been predicting it for at least that amount of time. It's coming. It's going to happen. We've seen rates by the Fed, which controls a lot of the interbank stuff that goes on, as we've all talked about on this show many, many times. That particular number keeps rising, keeps going up. Now, we did see a pause last month in the Fed raising their rates, and I think we're at 5.25, 5.75 in that range in terms of what the rates are, and that's a Fed interbank rate that they lend money to each other. But it affects everything, and it affects mostly how banks lend money to you. You want a mortgage, you want a credit card, you want a car loan. All of these things are affected by that particular benchmark, which the Fed paused. Are we going to see more raises by the Fed? Yes, they say at least another 2, bringing the actual, what they call the benchmark, or the bottom or the floor of that particular rate to right around 5.75 to 6.25%, depending. Now, that's a big number. But the economy keeps roaring along. Now, I say roaring along. What does that mean? In the U.S., our average GDP over the last 10 years is about 2%. So if we are at 1% in Q2 this year, we were predicting a recession. And we are still, and depending on who you look at, looking at recession in terms of what Bloomberg says, in terms of what the major banks say, whether it's, Chase, Manhattan Bank, Jamie Dimon, whether it's Moynihan over at Bank of America, whether it's any number of different, El Aron, he is the chief economist. I forget exactly where exactly he is, but all of these people have been predicting this particular recession, and it isn't happening. So how does this affect markets? How does this affect you as a buyer out there? Obviously, if you're working, you got a great job, and you're making good money, that's always the main thing that banks look at when they're looking to do your loan. Looking to do your loan is the number one thing that most of these mortgage lenders, whether it's United Wholesale, whether it's Rocket Mortgage, or whether it's any number of other. And that's what's been happening. So how you are determined to, how are you supposed to determine what kind of forward motion you have on purchase of that house? Now, the other shoe that dropped and has been dropping is that prices, which had sort of retrenched for a while, have remained pretty strong as well. Now, we have seen the first year-over-year decline, meaning this time last year, the prices were higher than they are. This is the first time this has happened since 2012. So you can see that the forward momentum or the upward pressure on prices has been consistent, long-term, and incessantly nonstop. And all of that is, it is what it is, right? I'm talking to an investor buyer today on the phone, and they were trying to figure out whether they should pay discount points to get a lower rate or to be able to accept a higher rate and pay more money. So that calculation for investors is, how long are you going to hold that particular rate? How long are you going to hold that property? And is it worth to buy down the rate at a certain price if you average out the cost savings between the rate that you could get at no cost, between the rate that you're getting at some cost? And, these kind of calculations are what a lot of people are doing, even people who are just buying for single-family use. If you're looking at the market and saying, okay, if we get a recession, we will see mortgage interest rates fall. That's how we started the show. Mortgage interest rates falling a point means that you're going to save $100 per percentage point that you borrow. So if you go from 6% to 5%, you're going to save roughly $500 a month, right? If it's all things being equal, that's what you're going to save. Now, that's a big savings for some people. But if you offset that with, hey, if you wait a little longer, we may get down into the 4s. So these kind of calculations, as I said, are things that buyers have to look at now, especially if they're looking at long-term interest rates, short-term interest rates, how interest rates are affecting, and what the recession means or doesn't mean. So recession watching, which is what we do, as I said, in the mortgage industry all the time, because recession means lower rates, and lower rates in the mortgage business means we're doing well. As everyone knows, during COVID, when we had a lack of demand, mortgage rates fell through the floor and our business was booming. So if the mortgage banker, broker, bank in your area is doing poorly, that means the economy is probably doing pretty well and rates are up. So there we are. Let's get it to, speaking of rates, let's get to a couple of the rates and what they are currently. Okay, the 30-year fixed rate is 6.92%. The 15 years at 6.32. That 15-year looks great, right? 6.32%. I mean, it's a good half point less than any of these others. If you're looking at the 30-year at 6.92 and the 15 at 6.32, hey, we're at almost 0.6%. That's a big, big savings. If you can afford the extra monthly dollars that it's going to take you to get into that 15, that's a great product. Often we see certain segments of the market. Now, we've been talking about this 5-1 ARM. Today is at 6.89. Nobody wants to do the 5-1 ARM because it's too expensive. It used to be that if you did a shorter term loan, you got a better rate at that short term, meaning that you get 5 years fixed and then it's adjustable after that. Not anymore, because the lenders don't want to do it. They want to offer it, but if you want it, you're going to have to pay for it. Now, why you would go for 6.89 when you're at the 30-year, you can get 6.92, which is pretty much baked in that particular rate for 30 years, where the 6.89, hey, it may go up to 7.89. It could adjust, and it could continue to adjust. So the adjustable rate mortgage, the 5-1 ARM, a little sketchy. So if we're talking about FHA, right now 6.63, and the jumbo's at 6.75. Still in the 6s. We have obviously come back from where we were a couple weeks ago up in the lower 7s, and that's a good thing for you as the consumer. Obviously, you're paying less for the loan, you're paying less for the house, and all things being aside, rates are what they are. What we have recently is a lot of borrowers out there are talking about getting used to these types of rates. A year ago, when we started seeing rates rise, and we were in the 3s for forever, what happened? People would balk at it. They were like, wow, I'm going to wait. But after a year, you forget about those rates. Those are like ancient history. So you're really looking at 5% is the goal, right? Oh, man, if I had 5% rates again, that'd be awesome. Well, you may have 5% rates again. That's a possibility. The 3%, no, never happening again, unless, of course, we had another catastrophic event, a world economic event, a pandemic, something that would drive worldwide prices to nothing. And in order to stimulate business, you have to lower interest rates. Yes, everybody knows that's what exactly had to happen. But in this market, if we're currently a 30-year fixed rate, almost 7%, so let's say 6.9%, and you want to get down into 5.9%, that's a possibility. And it's a possibility this year. As I said, Bloomberg, Bank of America, and JP Morgan Chase, they're all predicting recession at the end of the year. The question is, what happens when that happens? Well, that's why the calculus right now for a lot of people trying to get into a mortgage is so darn confusing, because you have to make those decisions. And as I referenced earlier, the person who was talking with earlier today was an investor, had a lot of other properties, and we're trying to figure out what the best course of action for them is. And it's not a simple calculation because there's risk either way. But like I say, getting into the market is the best thing to do. I always say, unless you're in it, you can't win it. Even though you're trying to build equity and do a lot of things, unless you own a property, you can't do any of those things. So if you can afford the monthly, and there is some, path to getting to your loan to buy the house, it's probably a good idea, even at these prices, at these costs. There are a couple other things. Let's see, home prices, first annual decline, as I said, since 2012, and the Treasury yields rise. We've seen we talked about the yield curve inversion. Now, for anybody who's new to the show, that means the 2-year and the 10-year invert. It used to be that the 2-year yielded less than the 10-year, meaning that when you buy treasuries are what really dictates what mortgage rates are. U.S. Treasury 10-year, whatever that is, you can determine whatever the rate is by that particular number. Recessions are usually foretold by when the 2-year is yielding more to you, the buyer, than the 10-year. That's called an inversion. Does it make sense? No. If you're going to invest money long term, you want more money, right? If you're going to give somebody a loan, you want the highest possible rate at that loan. You don't want the highest possible rate at a lower term, i.e. 2 years, but that's what's been happening, and that's what has foretold what's been going on forever in the recession. So it's been flashing, and it's currently up over 100 basis points, that's a big number, for quite some time. So what is going to happen? How is it going to, affect the market? Will we get into this? This is all what I call fascinating, what most people call crazy making, because it is. I mean, if you're out there as a borrower trying to figure out what you're trying to do with your mortgage, whether you're going to buy, whether you're going to sell, at what rate, is there a recession? Is my job safe? It's really a frustrating time right now. Okay, a couple other things in the economy. We talked about how the economy itself was doing actually pretty well. Okay, the economy. Purchase of new homes. Yes, it's up 12%. Durable good orders topped estimates. The consumer confidence is at the highest it's been since 2022. Housing prices are up 3 months in a row, up 12%. Recession, yeah, we talked about that. Is yes, is no. What are some of the salient points that lead us to believe one way or the other? The data says no. It means the resilience is and remains the watchword. It's pretty strong, the economy. And now, is that because there was so much money spent during COVID that we're just now running into the savings that we had? I mean, there was $1.5 trillion in savings accounts 6-8 months ago. Is that why? Because we still have extra money that we're spending? Or is it because all of these things I just mentioned, new homes, durable goods, consumer confidence is all up? People are feeling pretty good about themselves. Those are the questions to ask when we talk about the economy. Retail sales, inflation-adjusted consumer spending, and the job market. These are all things that we look at when we look towards what's happening in the economy. These are all up. These are all doing, fabulously well. Yet, if you look at some of the surveys, depending on where you get your news or where you get your information, it sounds like the roof is falling in. It sounds like, oh my gosh, this is the worst thing that's ever. It's really not. We came out of a pandemic worldwide. Government spending was a certain atrocious level worldwide. We have solved, for the most part, high inflation, even though they keep calling 4% inflation high. Well, it's higher than 2%, but it's certainly less than half of 9%, which is where it was. And some of the products that are out there that really, what I call greed inflation, they're going to readjust too, especially if demand is less than what it should be. Especially now, oil prices. Why is gas $5.50? I don't know. Oil prices are $70 a barrel. So, when it's 140, yeah, I can see $5 and $6. That's what it was 2 and 3 years ago, but not now. Okay, a couple other things here. Job market all strong, suggesting recession is far off, if at all. Yes, all those things are true. And listen, if you're out there and you're trying to figure this out, I understand your confusion. I understand where you're coming from. But you need really somebody to try to guide you to the best product out there. And each product that is available out there, if there are costs to it, what the costs are, and be able to work with a partner that can help you get into a loan so that you get into the housing market. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, we have this information available to you each and every week. We bring to you information about the economy, about rates, about programs out there, certainly. But mostly we try to, in the initial segment of the show, talk macro, big picture items. To get into the nitty-gritty of products and loans and stuff like that, I'm not the expert, so I bring experts to the show, and one of these experts was gracious enough to join us from her wherever she is on the road right now is April Lopez from Nations Direct Mortgage, and she joins us now. April, how are you?
I'm doing great, Jeff. How are you?
I'm fine, thank you, and thank you very much for helping me out today, coming on the show at last minute notice.
Absolutely, my pleasure.
Okay, let's talk a little bit about programs, what's coming up this summer to try to alleviate some of the borrower anxiety out there. Rates have settled back down once again below 7%, which is a good thing. I think we'll probably settle in the mid-6s to high 5s probably for the rest of the year, especially if we see the dreaded recession come, but the recession means lower rates for a lot of people, so they would be happy about that. Give us an idea about your take on it and some of the programs you're offering over at Nations.
Well, what we're offering now at Nations Direct, and we're seeing a lot more as consumers are still spending. We've seen credit card usage has increased dramatically. So instead of refinances for all of those borrowers who have the mid-2% to 3% interest rates on their first mortgages, we're offering second trust deeds. We are not offering HELOCs, which are home equity lines of credit, but we're actually offering closed-in second trust deeds for those borrowers who need cash to either pay off their credit card debt, who want to purchase a secondary home, or for whatever their leisure is.
Okay, so in the second that you're offering, now I understand, who would want to get rid of a interest rate between 3% and 4%? Nobody, right?
Correct. No one's looking to do that, and these seconds become some relief because everyone thinks that once we enter into the recession and the rates lower by the end of the year, beginning of the next year, then they have an opportunity, say in 18 months to 2 years, to refinance and then maybe come to a more affordable payment with a lower first. Maybe not as obviously not going to be anywhere near what they have, but at least pay off any second trustee they take out.
Yeah, I think that refi strategy is sound. I think anybody purchasing in this market today is looking for a refi, i.e. recession. We're not quite sure when and if it's ever going to happen because we've been talking about it for over a year. One of the things about the seconds that I wanted to ask you is I had some clients, they had some seconds done, but it took longer. What's the difference between when you underwrite for a first trust deed versus a second trust deed in terms of the demand on documentation and that sort of stuff?
Well, actually, you know what we did to help the consumer out? We actually made it easier. So not only are we offering second mortgages with full income qualifying, meaning 1 year of income documentation, but we're also accommodating those self-employed borrowers with 12 months of bank statements, and they're closing in less than 21 days.
Oh, that's excellent. Yeah.
Absolutely. So you've got a fully amortized second trust deed that we're making it seamless. And I'm telling you, I'm seeing so many more of those. And, you know, it also helps the broker, the loan officer, retain their client who might not be interested in getting rid of their first, but they can give them the second and then make the client happy, and then they can come back around in 18 months to 2 years and be able to, you know, help them on another first refinance.
You know, there are advantages, right, to a HELOC versus a second. What's your take on the advantages of a second versus a HELOC?
What I like about the second is it's fully amortized and fixed, and that consumer can take a 20-year, a 30-year, fully amortized fixed rate, so that means their payment is affordable and the interest rate isn't adjusting every 6 months to a year.
Right, and that's the problem with the HELOC, right? And especially if you're using part of it, whether you have a revolving line of credit, there's all kinds of things with the HELOC that are not as easily understood as somebody who's used to paying a first trust deed at a certain price every month. That would be the same that you're offering on the second trust deed every month.
Absolutely. And when you look at a HELOC, I mean, these interest rates, you know, are starting out at 7% anyway. So if you and they're adjusting. So if you take a second trust deed fully amortized at 9.99, then you feel a little bit, you can rest assured that your payment's going to be fixed and you don't have to worry about the volatility of the market.
Yeah, and I also think that if you're looking at it and you're looking at something, these loan sizes are a lot smaller than the first. So whatever the rate is, the payment's going to be fairly, I mean, what are your average loan size on these seconds that you're doing?
Well, I'm averaging probably around, interesting enough, in California, 150,000 to 200,000, and
Wow.
so those payments are very, affordable. They're anywhere from $1,000, they're anywhere from like $1,400
Right.
to $1,800 a month.
Yeah, no, that's exactly what I'm saying. I mean, the affordability of something like that, the fixed rate of it makes it much more attractive than just not knowing, unless you're really savvy. And I haven't really run into Mr. and Mrs. really savvy out there lately. Most people have their hair on fire right now because they're not quite sure what's happening both in the economy and, loans are harder to get in a lot of ways, and demands on documentation and such. So you're offering a product which actually isn't in terms of the second.
Yeah, absolutely. And I think now the consumers have finally realized that the rates are going to be where they are for a little bit now.
I agree.
So now they realize we got to buy. It makes sense to buy.
Yep.
And, they're now, entering into this purchase market and being, okay, I can accept this 6.5% rate, knowing that long-term goal is to eventually refinance in hopes that, our economy bounces back and the rates lower.
Well, that's the thing. I mean, if you have a roaring economy, you're going to see the Fed continue to raise rates, right? Because they want to tamp down inflation. That seems to be the game plan. How does that affect mortgage interest rates in the long term? It's going to also tangentially raise those rates too. So really, whether you like it or not, a recession would help the mortgage interest rates in this particular market, right?
Oh, absolutely. And
Right.
I think also coming around the next year with the election, how that all plays into it. So I think you're going to see them kind of slow it down a little and then wait for that election to come around. And then there's going to be a lot, to talk about. They're like, oh, we've got election, a new president's in. Let's look at our economy and how can we adjust.
Yeah, well, it's funny you say a new president. Yeah, I think everybody is tired of the whole crop of these people. So, yeah, I'd love to get some new blood and somebody to have some vision, especially when it comes to finance and whether it's CFPB or whether it's FHA or whether it's HUD or any number of other ways by which the federal government gets involved in loans to be able to make affordability a key component of whatever we're doing. Because really, I'm looking at FHA rates today. They're no picnic either.
They're not. And the only thing that HUD did was they said, hey, we're going to lower the monthly MI factor so that we can make those higher loan to values, less down payment loans, FHA, more attractive than Fannie and Freddie loans right now. And they want to be in the ballpark. So that's been really nice. We're seeing more Govy loans being originated right now than ever, or not than ever, but in this kind of market.
Sure.
And so it's opened up, for borrowers who have lower credit scores, even for borrowers who are in a certain income bracket based on where they live, they're getting some loan level price adjustments to help them have more buying power. So that's kind of nice for the new buyers in the market.
Absolutely. Let's switch a little bit, talk about real estate. I know that real estate prices have really, they've remained pretty strong. And that's a good thing for those people who have mortgages that are in the 5, 6, 7s. Where do you see real estate prices going? Where do you see the availability of properties coming from? Or do you?
Well, it's all demographic, but I feel like in our market in California, using that as an example, it's thriving. So at first, I thought, it's not going to increase exponentially like it has in the past 2-3 years, but it's a steady, still 6%, 4 to 6% increase. And there's still, full offer, even over ask price, merely because the inventory is low.
Yeah, I agree. Now, obviously, you know a lot about real estate. Have you really seen multiple offers on a lot of properties out there?
We are, and we're still seeing contingency removals, and we're still seeing a lot of activity. And it's a good thing, right, to keep the market the way it is. But I thought maybe in the outlying areas in some of the suburbs, there might have been maybe a 10% decrease, but all in all, it's still, the market's still thriving, and there's still, a lot of buyers out there that need homes.
Yeah, quickly, I have about a minute and a half left. I saw an article today online that talked about a couple of lawsuits winding their way through the courts, and this has to do with real estate commissions to buying and selling offices, in that the seller is trying to say, hey, wait a second, why am I paying for the buyer? They're trying to separate the two commissions, and as I said, the upset in real estate markets is always something that I don't know whether it affects the consumer in a good way or affects the consumer in a bad way. But disrupting current pay structure, I don't know if you've given any thought to that, but if you have, what's your take on that?
Well, you know what I've always found in the commercial sector of real estate is that the buyer always paid fees. I was always in residential, so I think that what has happened is, I'm still seeing full commissions. I think that, we had different little agencies come in and they tried to take the market by saying we're going to only charge the seller 1%. And I think those days are gone, because the service and what those, full brands can offer outweighs a 1% commission. So I think that, yes, disrupting the commissions, especially what just recently passed with properties that were worth over $5 million, they started having a higher percentage of tax on those sellers. Yep. It was a shock for a brief moment, and then I think it all subsided, and everyone's like, it is what it is.
April, thanks very much for coming on the show once again, telling everybody exactly what's happening in the mortgage industry, products as well. Love the second, but I appreciate you coming on the show.
Yes, thank you for having me. You have a wonderful day.
And you too. That's April. Oh, April, could you shout out your phone number for people who need to get in touch with a terrific loan company?
Oh, yes. April Lopez, Nations Direct Mortgage, 818-398-1272.
Excellent. Thank you. Sorry, I forgot that part. I got a head cold, so I'm not all together here today.
Don't you worry. You feel better. Thanks for having me on the show.
Thank you very much. April Lopez from Nations Direct. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Listen, if you want to see this show each and every week, we're on YouTube, Jeff Barton, the Mortgage Voice, and we've been there for hundreds and hundreds of shows over many years. If you want to see us, Jeff Barton, the Mortgage Voice on YouTube. We also are on, we have a website. Yes, we do. It's themortgagevoice.com, and if you go there, you can see and hear the show, as well as a number of guests that you can contact directly through there. That's themortgagevoice.com, and a bunch of other stuff that I'll talk about a little bit later in the show. It's an odd time in the marketplace because of the fact that not only do we have high interest rates, but we've also got a number of consumers looking for a better home, a different place, but there is nothing out there to buy. So what happens in these situations is we get some people in the business who fall out of the business. And what happens to those companies, to those people who are in that situation, is why I bring our next guest to the show, is Greg Thompson from Secondary Marketing Solutions. Mergers and acquisitions, what happens to companies if this happens. Anyway, Greg, how are you?
I'm great, Jeff. How are you doing today?
I'm okay. Got a bit of a cold, but other than that, I'm pretty good.
Very good. Well,
how are you feeling, by the way?
Vitamin C.
Yeah.
I'm all good. Thank you.
Okay, excellent. All right. So first up, can you just describe a little bit so our audience knows exactly what this interview is all about, what you do, and how you do it?
Sure. Secondary Marketing Solutions, we've been around for 17 years. We're involved with community banks and mortgage companies that are trying to manage interest rate risk, but also trying to navigate all of the peaks and valleys that this industry has gone through over the last, 20 some odd years, even longer than that. I've been at this for, a little over 40 years and have extensive experience with the agencies known as Fannie Mae, Freddie Mac, Ginnie Mae, and I'm a former Fannie Mae person. And so basically what's happening in this market, when interest rates were low, everybody wanted to go ahead and jump into the mortgage business.
Sure.
You had every Tom, Dick, and Harry that was out there that came running. And as you know, we ended up in a financial crisis in 2008 as a result of that.
Uh-huh.
And so as that particular credit box, as we call it, subprime, disappeared, then everybody that couldn't make it in a normal market or normal credit market kind of went away. And the industry was damaged heavily during that particular time just due to the fact that you couldn't get any more entrants to join. When I got into this business in 1980, we were all young people, 23 years old, 24 years old.
Nice.
And guess what happened?
Yeah.
Well, 2008 came around and nobody was coming into the business. So our business has aged dramatically. And I think that a lot of us who, attend mortgage functions and things like that will see that there's not a lot of young people that are there. And hence, mortgage bankers that are still in the business today, they're all, older folks that are getting ready to retire.
Right.
My practice is basically with the family-owned business. And so with that being said, I got a lot of husbands and wives and,
sure.
and brothers and whatnot, and they've all, they've got these companies that they don't really have anybody to turn them over to. And so that, has brought a market, to myself and a couple of other companies in the country that actually, deal in the M&A market, was specifically with the family-owned business. And it's just, it's created an influx of a lot of people looking to sell. So it's being driven by age. It's also being driven by the fact that interest rates have gone up dramatically over the last 18 months. And that easy transaction or easy qualification isn't there anymore. So
right.
Trying to get a borrower to qualify at current rates today versus where we were at during the pandemic, down, in the 2.5% market is just, you could get a lot of people to qualify then.
Tell me something, Greg. In a typical transaction, what are you looking for in terms of return for the client or satisfying the buyer? Because I assume you got to stand on the fence and work with both buyer and seller, i.e. the owner of the company or somebody who's looking to get into it. And if you, as you say, a lot of people are getting out of it, how does this affect overall the quality of loans that consumers are being offered if there's fewer and fewer people in the business?
Yeah, so generally what happens is that if there's a stock sale per se,
yep.
Where there's somebody coming in and actually buying the company and there's new shareholders coming in, what I found with recent transactions is that it's brought new capital into these companies that were struggling.
Right, I see.
Therefore, and it has allowed the company to go out and sharpen their pricing, increase their investor base of where they sell loans in the secondary market. And it's given them a lot more options.
Right.
For the company and the employees who are working there. The companies that, have lost money over the last, several, I want to say the last year, 18 months or so, since this new cycle's come on.
Right.
They need fresh cash. And so, what that has done is that they've been able to exit and whatnot. And the thing is, for the owner of the mortgage company to answer that question, it's in a very emotional trade.
Sure.
For them.
Mm-hmm.
I'm talking about, this is their child. They gave birth to this company and they ran it over the last 25 years. And I'm using an example that I recently had done, and it's kind of devastating. There's a grieving process that goes on.
I see. Uh-huh.
So I try to do my best to be compassionate about that because, I've bought and sold a lot of companies, but, I wasn't married to any of them.
Right. It's a business transaction for you. Right.
Right. And so therefore, it's a process. And I know from selling companies that myself, once you sell it and all of a sudden you're kind of standing on the sidelines looking what other people are doing with what you have built. I mean, you generally just want to get the heck away from it,
right?
And get down the road. So that's kind of both sides. You got a super excited, buyer that's coming in there who's going to do all these things with your company, and then you got a grieving process. Even though the seller, is going to be compensated for doing it, but there's a sense of loss that goes on there.
Oh, that's interesting, the psychology of the whole thing. And you're seeing this mostly on the mom and pop shop, or are you dealing with larger entities as well?
Yeah, I do. Some of the mom and pop shops are the most, they're the most difficult. Mm-hmm. Sometimes, and there's, one of the owners has passed away or things like that.
Right.
And it doesn't necessarily mean that, I've had a young person pass away that was integral to the operation. And it just, it's a tough road on that.
Yeah, it is. Yeah.
So, but, for the larger institutions, and I am involved with private equity currently in a transaction that is actually a seller. And so they bought a mortgage company, but they stripped all the assets out of it. Sold those assets. And so now they have this shell of a company that they have management in that's still operating, but there's a new person coming in there. Those are very clinical. Mm-hmm. I mean, it's not like you're
right. No, you're not married to it, right? It's not an emotional sale, right? Yeah, no, you're just looking to plug in players so that you can make the entity, viable.
Exactly. And having that, that legacy, so to speak, and domain names and things like that for a business, it's sort of like buying a franchise.
Right.
And you've got your McDonald's or your 7-Eleven. You can build off of their brand. And so and that's what makes it attractive to a buyer, if in fact that company has a good reputation, obviously. But
tell me, what do you foresee in the next 18 months in terms of mergers and acquisitions? Do you see that there's more credit going to be available? Therefore, a lot of these companies may just benefit from staying whole, or is your business cyclical that way, or is it pretty much steady all the time because there's always people getting out?
Yeah, there's, I'm involved in the startup side of the things too.
I see. Okay.
And so while I've probably done, probably in the last 18 months, I've done 6 or 7 startups.
That's a lot. Yep.
Basically from broker to banker and helping people navigate all of the ins and outs of the governmental bodies that oversee this industry.
Sure.
But also too, I kind of see a little bit of it all the time. Right now, I'm super busy. I was super busy back in 2009, 2010 with this because it was, and it's super cyclical.
Okay.
But also too, when the market's really, really good, it's really hard to get someone to sell their company at the top of the market.
Sure, you're making a ton of dough. Why would you do it then? Right, exactly.
Exactly. Yep. So, but then when the market goes away and you tell them, well, this is what your company's worth now.
Yeah.
Well, why can't I get what it was worth back then?
Yeah, exactly. Why can't I sell at yesterday's prices? Hey, Greg, listen, we're up against it right now. Really appreciate you coming on the show. If you could shout out a way by which anybody who's listening can get in touch with you, that'd be great.
Yeah, our website is 2Mark Solutions. So it's www.2MarkSolutions.com.
Excellent.
And, you can grab us right there.
Excellent. Thank you very much. I really appreciate you coming on.
All right. Thank you, Jeff.
Sure. That's No problem. Greg Thompson from Secondary Market Solutions. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton. This is The Mortgage Voice, and thanks very much for tuning in to the show. Each and every week we bring to you information regarding your choices in the mortgage industry, whether it's loan, whether it's company, loan officer, program. There's a lot of things you got to know about, and if you don't tune in or at least figure it out on your own, you are on your own. So in order to be able to help you, you got to listen to what we're doing. You can see us on YouTube, Jeff Barton, The Mortgage Voice. That's our weekly show that we put on YouTube. We're also at KCAA. That's our Inland Empire radio station, and they are great folks over there that bring our broadcast to Saturday and Sunday listening audiences in the IE. Also, we can be seen and heard on a number of different podcasts. Do we have those podcasts today, Daryl?
Sure do, Jeff. It's Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and, of course, the MortgageVoice.com.
Excellent. MortgageVoice.com, great website, and Podclips.io. It's a central place where you can see and hear all kinds of different podcasts in one location, whether it's finance, lifestyle, sports, health, all good, honest, hard-working Americans out there trying to do what they do, which is inform you to the best of their ability, and it's a really pleasant listen as well. Joining us once again for the Mortgage Voice today is Charles Giscombe. He's going to tell us a little bit about what's going on in the market all over the U.S. and some programs that he's also familiar with. Charles, how are you?
Great. Thanks for having me today.
Thank you very much. I know you're on a plane. I very much appreciate you coming in. Tell us a little bit about some of the programs that you're offering now to your clients out there in the mortgage world.
Well, I'll run it down real quick, Jeff. There's a lot of stuff out here to keep people involved in this market right now. Since the market's still holding its value, there's a lot of programs that individuals can get into. We know the interest rates are high, but at the end of the day, there's a lot of traditional loans as well as non-QM loans that will offer you different options to get in. The non-QMs consist of bank statement loans, consist of profit and loss loans, CPA, I-10 loans. They also have 30 and 40-year options that will allow you to stretch out that amortization to allow you to make a lower mortgage payment at all, like you were having a lower interest rate and that you were used to before. So there's a lot of stuff that we offer, a lot of stated loans for commercial investment and for investment flip products. So there's something out there for anybody. As long as you have the ability to repay, there's a loan for you, and Malibu Funding prides itself in providing you that kind of opportunity and those options.
You know, we often talk about getting into the market to be able to avail yourself of opportunities coming down the line. Obviously, if you're not in or you don't own a home or a real estate investment property, you can't take advantage of the equity that's built up over time. So the non-QM world, which are some of the loans that you've been talking about, is a way by which people who maybe not fit in the traditional credit box, that's what we say when somebody just either doesn't want to disclose entirely everything about themselves, they want to use a bank statement or some of the program. These kind of issues that borrowers deal with, there are ways that you can get into properties, and this is what you've been talking about.
Absolutely. There's a lot of individuals that don't have that traditional structure, can't provide the documentation that is, have a lot of equity in their home, and they feel like they're at dead ends, Jeff, but that's not the case. We have the ability to provide investment, home equity lines of credit, HECMs in different situations that you can qualify through non-traditional documentation. So there's something for everyone to be able to still get into this market and purchase and tap into the equity in their homes.
You've been a loan officer for a long time, doing business in a lot of different areas, a lot of different states. How have you seen mortgage and real estate trending over the last, 60 to 90 days? And if you see something out there in the future that may be an opportunity, could you share that with us?
Well, you know what? There's a lot of opportunities out there. One thing I can say for sure, it's not like it was in the other markets when the crash happened and it was devastating and everyone was afraid. There's a lot of people that are still interested in getting involved in the market. Right. So what I see is that even the non-QMs that are lenient already becoming more lenient. Jeff, I see some people coming back up on their LTVs, getting comfortable with less documentation.
Right.
Even some coming back into the stated realm. And the reason why, we have to be honest with people, is because with those lower LTVs, people are less likely to walk away from these homes when they get afraid or they feel like it. Also, the market I see is not upside down or not going back it was like it was in the crash. So individuals find stability and have some footing underneath them to allow them to get into the market, feel comfortable in it, and even if things get a little shaky and the interest rates increase, they still feel like they have stable footing and not in quicksand falling underneath.
You know, we often decry what happens when the federal government gets involved with anything. But if you look at 2008, the crash that happened at that time, because of the not the quality that we want to see in mortgages. The quality was terrible. The bond rating services weren't great, but that's been cured. The activity that has been going on since 2008, and we're now in 2023, so let's say 14, 15 years, has actually made the mortgage market really strong. And I think that particular aspect of the mortgage industry is what's saving us right now, because the paper is great, and people are still excited about buying into this market because of the resiliency both of the mortgage market but also of the real estate prices.
I completely agree with you. What I will tell you is that the bad paper that was mixed in with the good paper that caused us to have the issue in 2008, the fail-safes were put in place so that we didn't have to worry about that this time around. A lot of fail-safes put in place. There was a lot of different programmings, and I'll be honest with you, a lot of the lenders tightened up on their programming, and they decreased their LTVs just to hedge their bets. And because of that, it allowed us to come back to a strong, a more nourished environment in regards to mortgages, and allows people to stay in the game and have confidence going forward that they'll be in the game and not have to worry about the same things that happened in the crash in 2008.
You know, what I've noticed over the last couple, 3 weeks, maybe couple, 3 months, is that there is still a great deal of tension, i.e. in borrowers or sellers. There seems to be an anxiety-based reality check because the rates have gone up so much. And if you are trying to get into a home and there is some issue with either your loan or the speed by which it happens, there seems to be that kind of anxiety. Whereas in a market where, you know, rates were a lot lower, it was much more relaxed. Are you seeing that too?
Absolutely. I'm seeing that a lot. And you know what? With this particular situation that we're in right now, people, you know, I think because of the shock and the things that have happened in the past, we have a little bit better and more educated audience, Jeff. We're a little bit better educated in regards to what has happened. I feel like this market can continue to thrive, and if individuals just, you know, you have to have great loan officers and knowledgeable people in your corner. But I think at the end of the day, Jeff, this market is fine. But the trend of this right now is that the sellers still believe that they, you know, some sellers still believe, Jeff, that they have more appreciation or in their properties, and they're trying to cash it all out at one time. This is not a greedy market. This is a market where right now you just need to make your move, be conservative, stay stable, and you'll be okay.
Yeah, no, I agree with that. And I also think that if we ever have that recession or whatever mild recession that comes down the pike, we will see interest rates lower. So if you get into any kind of a property right now that's, let's say, 7.5%, you're probably going to get an opportunity to refinance that property sooner rather than later.
Absolutely, Jeff. That's a great strategy. A lot of times when we're speaking to individuals, we're talking, you know, just like you're talking about in life and your business plan, the same thing occurs and applies with your mortgage. Short-term and long-term plans. If you have a short-term plan to get into a property, I think it's a great opportunity for you to get into a property, use these programs and from a leverageable standpoint to get you in with less documentation. At the end of the day, the interest rates might be a little bit higher, but you also, if you're in a loan that has no prepayment penalty, you have the ability to refinance into the lower rates when that does happen. So that's a strategy that I tell our clients all the time. Don't look at this as a long haul at a higher interest rate. Look at it as a short-term strategy, and then when the market corrects itself and the interest rates do get a little bit lower, if there is sort of a recession that happens, you have the ability to refinance in, and you'll be where you initially wanted to start at.
Well, I think if take COVID out of the equation, I think we're kind of right where we should be in terms of rates historically. I mean, this is not like historically high rate market anyway. It's just that people get used to a certain thing in a certain way, and it takes them a while to get used to the new certain thing, certain way. And I think that's where we are now. But again, I think there will be some opportunity if, in fact, we do see that recession, which from what I read, it looks like it's happening, but at what time and when and how bad, I don't know.
Yes, right now, a lot of people have had that 5 or 6 year beautiful, wonderful amnesia in regards to what the rates were 7 years ago as opposed to 6 years ago. And I think if we just go back, there's some people that have been used to being at 9, 10, 11, and 12% interest rates. So they just have to do a little bit of history work and to see that we're not off where we were. We were just very spoiled right now. And if you have a little patience and you calm down a little bit and you listen and watch the trends closely, and if you have loan officers that are willing to explain everything to you, then you'll be okay.
Hey, Chuck, thank you very much for coming on the show. I really appreciate it. I know you're sitting on a plane there. Please apologize to everybody around you, and we'll talk to you soon.
Not a problem. I hope I can get a loan off the plane, Jeff. Thank you so much.
Exactly, and shout out a way by which people can get in touch with you, if you will, please.
Absolutely. You can reach me in that good old Las Vegas, 702-328-5191. Again, 702-328-5191, or you can reach me at charles@malibufunding.biz. That's charles@malibufunding.boy, Isaac Zenith.
Thanks again, Chuck. I appreciate you coming on the show.
Thanks for having me, Jeff.
Thank you. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
Southern California's Mind Spring, progressive talk in Southern